Welcome to the webinar. All right, we're gonna let people load up here for a second. Can anybody do me a favor and raise your hand? Click raise hand if you can hear me. All right, good. People can hear me. This is good start. We're off to a good start. I just want to make sure that our clicker works here. All right, we're good there. All right, we're gonna give people a couple seconds here to load up. I left my guitar out in the other room. I was going to surprise all you guys and play some really bad guitar for you. Good thing though, so you don't have to go through that pain. My fiance's been talking about how painful it is to listen to me play guitar, so wanted to share that with you guys and then trick you. You know, it's a tax webinar, but not really. You're here to listen to me play guitar. All right, we're gonna give everybody a couple more seconds here. While everybody's loading up, I'm Brandon. I run the Real Estate CPA, so CPA focused in the real estate space. And then we've got two panelists on here from my firm as well, Ben Ragor and Taylor Brugna. They're both CPAs, also focused on the real estate space. We all invest in real estate together, not like literally together, but we all invest. And we're able to kind of bring that to our client base and relate to people on a more one-to-one level there. Taylor and Ben are going to be answering questions. So, well, for the most part. So if you type in a question with the Q&A button, which I'll make you test in a second, you will most likely have a reply from them. If you don't get a reply from them, they might be flagging it for me to answer live at the end of this session. So we'll leave some time at the end to do some Q&A. All right, let's jump into it. Okay, so we already did the click to raise hand. Everybody got that. That was good. I'm actually going to put everybody's hands down. Chat. I did not check the chat to see if, okay. Yeah, so I did disable chat for everybody. So don't use the Zoom chat, but pay attention to the Zoom chat because Taylor and Ben are going to be sending things out. So right now there's a link to the presentation in the Zoom chat. And Taylor or Ben, if one of you guys could go ahead and just send that again for the new people that just jumped in. That link will take you to our secure client portal. You should be able to automatically download a PDF version of this presentation. So pay attention to the Zoom chat throughout this webinar. That way you don't miss any important information. All right, the Q&A button should be, and I'm on a different side of this, so I think for the presenters, the Q&A button's at the bottom, maybe bottom right-hand corner. That's how you're gonna ask questions. So at any time, if you have a question, click that button, ask your question. We will get it, and then Ben or Taylor will either answer it or flag it for me to answer a little later on. Now, if you have personal details or anything like that, we're probably not going to answer that question. So we'll answer the more broad questions. We're not going to dive into anybody's specific situation. The other thing too is that everybody can see the questions you're asking. So please don't put any information in there that you don't want other people seeing. And if you want to ask a question anonymously, make sure you check that box to ask anonymously. So just some Q&A best practices there. A big disclaimer for you guys is that, you know, this does not create a client relationship. This is just our opinion on how we're interpreting the tax bill that was signed into law in December. There's still going to be a lot of guidance that needs to be issued. So we're still waiting on Congress, Treasury, and the IRS to issue further guidance for us. So a lot of this information in here, it's to the best of our knowledge, but it's all going to be subject to change as technical guidance comes out in the future. All right. Oh, clicker's not working. There we go. Okay. Why should you listen to us? We have over 300 real estate clients across the United States, some internationally. We only work in the real estate space, so we're niche in real estate. If you are a photography business and you don't have real estate and you call us up, we're going to say, go find a photography CPA. And we believe in proactive tax strategy and advice. That's like the big thing in our firm. We don't wait around for our clients to give us a call. We reach out and make sure that everybody's getting their strategy calls locked in. And then also our tax strategists, the majority of our tax strategists own investment real estate themselves, so we can see eye to eye. You can find us at therealestateCPA.com. You can also check us out on the podcast, the Real Estate CPA podcast. It's on iTunes or SoundCloud. And then please do connect with myself and then also Thomas. Thomas is up there because he was handling some of the other webinars. So yeah, feel free to connect with us on LinkedIn. If you're using the PDF link right now, then you can click. If you're using the PDF, you can click on either one of those links, and it'll take you right to our profile so that you can connect. Will the new tax law spur growth? According to the Tax Foundation, it will spur growth, a small amount of growth over the next 5 to 10 years. It's going to increase it's going to add an additional $339,000. See, I'm only thinking in money here. It's going to add 339K more jobs. That's the projection. We're expecting an additional $1 trillion in federal revenue. Again, this is all from the Tax Foundation. And everybody, on average, will benefit to some degree. Again, that's on average. But the top 1% will benefit more. So that's some interesting research for you to consider. We've got the individual income tax rates. They have changed. We're not going to run through all of these. I'm sure everybody's already seen these by now. The one thing that I do want to point out is that the 39.6% tax bracket is no longer in existence. They've dropped it down to 37%. And they've increased the threshold at which that top tax bracket now comes into play. So you can see married filing joint, you have to hit 600K. Single, you have to hit 500K. Capital gains tax is staying the exact same. So no change to the capital gains tax. The one thing that is definitely still in there is the net investment income tax, which is that 3.8% surtax if you earn over 250K. So something to kind of keep in mind. You could be in that 15% tax rate, but not actually be in that 15% tax rate because it'll be 15 plus 3.8. So keep that in mind, but no change there. The standard deduction has almost doubled. So married filing joint, we've increased to $24,000. I say we as if I'm in Congress. I'm not in Congress, nor do I want to be in Congress. But the standard deduction has doubled. So married filing joints increased to $24,000. Single has increased to $12,000. Personal exemptions have been eliminated. So this actually kind of hurts families. And we have an example here. So a family of 5, you have 2 adults, 3 children, previously received a standard deduction of $12,700 and a personal exemption, or 5 personal exemptions. So the total here was $32,950. That same family in 2018 will only receive a $24,000 deduction, assuming that they take the standard deduction. So they actually lose the benefits of these kind of like what we call freebie benefits that were previously written into the code. That said, Congress has also increased the child tax credit, which we're going to talk about in a second, and that's going to kind of help offset the loss of personal exemptions. So child tax credit has doubled, and then the phase outs have also increased. So again, we've got married filing joint at 400, single at 200. That's much more than what it used to be. And 529 plans are now a little bit cooler to use. So if anybody's read my like Bigger Pockets blogs or even my articles at the Real Estate CPA, you know I'm not a big fan of 529 plans. I don't like illiquidity. I don't like contributing to a plan and then having to pay penalties whenever I take it out. So the 529 plans here, I've always been pretty much against, but I like them a little bit more now. We can now use them for public, private, and religious elementary and secondary schools. So it's not just for college anymore. So something to kind of keep in mind. Now, we're still big on the once your child hits the age of 7, let's pay them a wage. Let's get them involved in the business legally and legitimately. So don't try this without hiring some sort of CPA, please. But we want to pay a child once they hit age 7. Why age 7? Well, that's what the tax court generally supports as the youngest age that somebody can come in and start performing services for your business. So by age 7, we want to start paying them a wage, and then we would move that into a Roth IRA. That's kind of our pay a child strategy, and it tends to be a little bit better than this contribute money into a 529 plan. So if you have to do either or, we would recommend more on that pay your child strategy. If it doesn't matter, if money's not a thing for you and you can do both, then by all means do both. But now we're kind of also taking a little bit step back and saying, you know what, 529 plans now actually have more merit to them because we can just use them in a broader scope. All right, limits to itemized deductions. This has been talked about a lot. So we have the aggregate amount of SALT taxes, state and local. So SALT equals state and local, not like dinner salt and not like pass the salt or whatever, pass the salt bay or whatever that is. Anyway, state and local taxes are now limited to $10,000 in the aggregate. So if I earn $20,000 or if I owe $20,000 in state income taxes, and I also owe $10,000 in state property taxes, well, even though I've got a $30,000 total state tax bill, I can only write off $10,000 of that. So that's something to kind of consider when you're buying your next home, or when you're trying to figure out where you want to live. Maybe you move to a tax-free state. Something to keep in mind there. Now, that only applies to primary residences, right? Well, I mean, the state income taxes don't, but state property taxes, if you have rentals, you can still deduct the property taxes on the rental property. So there's no change there. Property taxes are still ordinary necessary business expenses. But for your primary residence, for your secondary residence, if you have property taxes there, you're now going to see a limitation. Interest deduction is now only allowed on the first $750,000 of acquisition debt for a primary and a secondary home. So if you buy a $1 million home, you can still write off that $750,000 or the interest on that $750,000 loan. Anything above that, though, is no longer written off. HELOCs, this is another big one. So refinances, HELOCs on primary and secondary residences are also no longer deductible. The interest is no longer deductible unless you use the HELOC for like rental activities. So if I take a HELOC on my primary residence and I go buy a rental, I can deduct the interest on the rental, right? So I'll deduct the interest on Schedule E where we report the rental. Or if I were to take a HELOC and then go and hire somebody in my CPA firm with that HELOC money, we could trace the HELOC interest into the CPA firm. So you can still use a HELOC. You just can't use a HELOC to like pay for student loans. You can't use a HELOC to pay for like an auto loan, and you can't use a HELOC to pay for renovations and then expect to deduct the interest, right? So you can always use a HELOC, you just can't deduct the interest anymore unless you're using it for business or for real estate. Estate and gift tax has doubled, so that's good. For all you folks out there that have a $10 million estate, you're now covered. But something to note, this only lasts, and most of these new tax laws, they phase out within the next 8 years. So I think it's 2025 where they all pretty much stop. So like, you know, the joke is that for the estate and gift tax, this is great for you if you plan on dying in the next 8 years. But if you don't plan on dying in the next 8 years, you might not benefit from this. So something to keep in mind, but please don't go and die. That would be bad. The Obamacare individual mandate, not a lot has changed here. They tried to repeal it originally, but what they ended up successfully repealing was the penalties associated with not having health insurance. That starts in 2019. They basically need a year to try to figure out how they're going to keep insurance costs low, because they're expecting an exodus of people as they realize they no longer need health insurance because there's no negative repercussion to not having health insurance. So the people that do want health insurance, you can kind of expect a rate increase because you're going to see all those other people leave. AMT, we're going to kind of skip over that. Basically, the limitations, not the limitations, the thresholds have been increased. So that is a good thing for folks that were subject to AMT. Pass-through business income. So this is the meat. So we've got this, and then we've got interest that we'll talk about a little bit later. And these are the two kind of big topics that we want to discuss with you guys today. Pass-through business income. Sole proprietors. So Schedule E. If you have a business and you file on Schedule C, have rentals, you file on Schedule E, you're a sole proprietor. Or if you have a single member LLC, you're considered a sole proprietor for federal tax purposes. Multi-member LLCs and S corporations, all three of those buckets are now going to get potentially going to get a pass-through deduction. The pass-through deduction is based on your qualified business income. Now, I know that we've got a big, long formula here, so technically the deduction is the lesser of combined qualified business income, or 20% of the excess of the taxable income, and all that stuff. But what you need to understand is, for the vast majority of you, it's going to be combined qualified business income. That's what your deduction is going to be. So what is combined qualified business income? Combined qualified business income is 20% of the qualified business income with respect to your trade or business. Or it's the greater of 50% of the W-2 wages with respect to the trade or business, or 25% of the W-2 wages paid out by the trade or business, plus 2.5% of the unadjusted basis of all the property owned by the business. And it's the lesser of these things. So lesser of 20% or the greater of those two things. So if you have a business and you net $100,000, that is qualified business income, most likely in that business. and you would be subject to a 20% pass-through deduction. So you get a free $20,000 tax deduction. It comes out after taxable income. So it's like the last thing before we start levying tax on your 1040. But if all you need to understand is that if you have a $100,000 business, basically your deduction is going to be $20,000, so 20% of your qualified business income. And I'm going to refer to qualified business income from now on as QBI. So just understand that that's what that means, but generally just net income. If I instead had a $100,000 net profit, but paid out, say, $100,000 in W-2 wages to get to that net profit, in this case in particular, I would still be subject to that 20% pass through. So my deduction would still be 20% of 100, so $20,000. But you can see how that wage, since I paid out wages, I paid out $100,000 in wages. You can see how that now gets factored in. So 50% of 100 of 50% of the wages that I paid out is only $50,000, and that's the greater of $25,000 plus the unadjusted basis, which is zero. We'll get into all that in a second. Just understand that this calculation can get complex, but luckily for you, there are limitations. So we have taxable income limitations, well, more like thresholds. If your taxable income is less than 157.5K and you're single, or 315K and you're married, then you don't have to worry about all those crazy calculation on the previous page. You just take 20% of your business's net income, and that's your deduction. So very simple. And taxable income, guys, is not AGI. So it's not adjusted gross income. It is your taxable income. At the end of the day, after all my standard deductions or itemized deductions, I then take my 20% deduction. Then I've got my taxable income. That's what we're looking at there. So taxable income, 157.5K, 315K. Ingrain those two figures into your mind. Those are going to be the two most important figures for folks that are hovering around those marks. We're going to want to figure out how do we drive that income below those thresholds so that we can just take a 20% deduction on your net business income. Service businesses, except for engineering and architecture, are not eligible for this deduction unless their taxable income is below these thresholds. So again, you can start to see the importance of these thresholds. There is a phase out for service businesses. So if you're married and your service business net income, or maybe your just combined taxable income is like $365,000, you still qualify for some amount of the deduction. But basically, once we get above those thresholds, the deduction begins to phase out. Once we're out of the phase outs, service businesses no longer qualify at all. So if you are a real estate agent, you're a service business. Let's say that you net $500,000 a year. You had a screaming year because real estate's been hot. You are phased out of these deductions and you don't get a pass-through deduction at all. So you don't get the 20%, you don't get the 50% wage limitations and all of that, those crazy calculations. You're just phased out, you're done. So we want to try to focus on how do we drive that income down below that threshold. Service businesses are wholesale in the real estate space, at least, generally include wholesalers, real estate agents, real estate brokers, property managers, and anybody that basically, if your revenue revolves around you having to go out and make sales, that's a service-based business. So if it relies on the skills or the reputation of a person, then it's a service-based business. So something to again, just kind of keep in mind. How do you avoid, if we're over the thresholds and we're a service-based business, how do we avoid or how do we drive down that income? Well, it's going to be a little difficult to, but one thing you could do is consider selling products. So if you can productize your business, maybe like ebooks, guides, tools, something along those lines, you will have you won't necessarily qualify for the deduction, but you might have some of that income qualify for the deduction. So the deduction on the product side might qualify for the deduction. So something else to keep in mind. And guys, remember, these rules, these new laws are going to be in place for the next 8 years. So this isn't something like, if you're like, I can't write an ebook right now. Yeah, I get it. Me neither. But I can in the next 8 years. All right. So something to think about in terms of your entire plan over the next basically decade. What are you going to do to earn more money and to diversify your income streams? Seriously consider productizing your service-based business if you have one. How does the pass-through deduction affect landlords? So this is the big caveat. We are still waiting on further guidance. We are not 100% sure on how it affects landlords. Basically, qualified business income is income generated from a trade or business. The question is, what is a trade or business? There is literally no definition in the IRS code as to what a trade or business is. Even though this has been litigated for decades, there is no hard and fast bright line test for a trade or business. So if with rental properties, what we do is we look to prior court cases where rentals or a rental portfolio has qualified as a trade or business. And it's generally when you actively participate in that trade or business. So we're making management decisions. We're doing new tenant approvals. We've got we're creating rental terms. We're doing the repairs. We're managing the property. That's active participation. If you have a property manager, you're still actively participating in that rental activity because you're managing the property manager. You're still making those decisions. So most of the landlords, it's in our opinion that most of the landlords with rental property, you will qualify for that QBI deduction, that 20% pass through, or the 2.5% of the unadjusted basis, which we'll talk about in a second. So you can breathe a sigh of relief. You are going to be, at least as far as we can tell, there might be some sort of technical guidance that comes out at some future point that says, nope, that's not the case. As far as we can tell, we're good to go for landlords. The one kind of caveat is that, I mean, there's lots of caveats, but one that you should be thinking about now is right now, the way that this works, as far as we can tell, the rental activities are aggregated together if they're not in a multi-member LLC or some sort of corporation. So if I have 4 rental properties and 2 of them are generating a $10,000 passive loss, and the other 2 are generating $8,000 in net income after depreciation and amortization, what I have is a negative $2,000 loss, a $2,000 loss. That's a double negative. I have a $2,000 loss. If I have a loss, I can't take that 20% of QBI. I don't get a pass-through deduction. So because we aggregate, what we could potentially do is take the rentals that are generating passive income and put those into a multi-member LLC. So maybe I have an LLC with my spouse, and we put the rentals that are generating passive income into that LLC. Because the cool thing about this pass-through deduction is that it's figured at the entity level. So if I put my 2 rentals that are generating that $8,000 passive income into an LLC, a multi-member LLC, or an S corporation, then the entity itself will qualify for that 20% pass-through deduction. So I, just made $1,600 I got a $1,600 tax deduction simply by moving these properties that were producing income into this entity. So that's another important thing that we want to be thinking about, and something that you probably want to work with your tax advisor on to kind of understand the implications there, because obviously a multi-member LLC also costs more money because you have to file a tax return for it. So we want to weigh the pros and cons. Why can't you do this in a single member LLC? Because a single member LLC is disregarded for federal tax purposes. So a single member LLC is still reported on Schedule E and would generally, at least in our understanding of the current law, would be aggregated together with all the other rental activities that you have that are like in your personal name. But if you separate them out into a multi-member LLC or an S corporation, then we can qualify for the QBI deduction at the entity level. So consider that when we're planning for entities there. All right. Landlords still have to worry about that threshold. So the taxable income threshold, the 157.5K and that 315K if you're married. If you're under it, you get the 20% QBI deduction, or the 20% deduction on QBI. If you're over it, then we now have wage limitations, and we're likely going to be using a 2.5% of unadjusted basis. I think that the next slide covers it. Maybe not. Maybe the next slide covers it. Okay, well, anyway, so unadjusted basis is the basis without land, right? So if I buy a property for $110,000, my unadjusted basis is $100,000. So if I'm over these thresholds, these taxable income thresholds, and I'm trying to figure out what my pass-through deduction is going to be, it's the lesser of 20% of QBI. So let's say that, let's just assume that my rental properties or whatever generated a net income of $10,000. So my QBI in this case is $2,000, 20% of my net income. But we also have to now take into effect the greater of 50% of W-2 wages, which landlords don't pay W-2 wages in most cases, so that one's a wash, or 25% of W-2 wages, again, 0, plus 2.5% of the unadjusted basis of the property. So if my unadjusted basis of the property is $100,000, then 2.5% of that is $2,500. So basically the way that this calculation boils out is my pass-through deduction is 20% of QBI, the lesser of 20% of QBI, or the greater of the other calculations, which we figured out to be 2,500. So I've got the lesser of 2,000 or 2,500. My deduction in this case is $2,000. So the important thing to understand here is that your unadjusted basis is going to matter more importantly than it has in the past. Not only do we get an increased depreciation write-off when we boost our unadjusted basis, but now it's going to affect our write-off that we get, our pass-through deduction that we get to take on our tax returns. So a tip for you, regardless of the size of property that you're purchasing, when you're going under contract, value land up front, right? So we can look to the property tax assessor database, we can look to appraisals, we can look to engineering reports. The one thing though about looking at a property assessor card, like if I were to Google, I don't know, Catawba County, North Carolina, and try to find a parcel that I owned, it would tell me the land value and the improvement value. And I could use that and apply that ratio to my purchase to understand what my land value and my unadjusted basis is. But if I do that, I'm using the county's basis for land. And the county values their land much differently than I value my land. I can't rent my land, so it's less valuable than probably the county actually says. But anyway, what we want you to do is consider pricing this in upfront. So whenever I write a contract for that 110K property, I want to say $10,000 of this is allocated to land, $100,000 is allocated to the building. Will it hold up in court? Yes, if you've done your research and you can substantiate it. And I probably shouldn't say court. Will it hold up under IRS scrutiny? Yes, it will if you can substantiate it. So work with your CPA on this. But by doing this, by reducing my land value, I then increase my unadjusted basis and I get a better pass-through deduction if I'm a landlord. All right, I think that we might have just actually covered this. We did talk about it does not work with single member LLCs. Sorry guys, I'm not really a PowerPoint guy. I mean, I was when I was at PwC and Ernst & Young. We did PowerPoints all the time, but I kind of just like to, just go off the cuff. And I also apologize for all the words. I also take the approach of like a Steve Jobs where you just got like the Apple logo in the background, but we wanted to give you guys something substantial that you could walk away with. So that's why, it's a little grinding my gears right now, but it's okay. How does the pass-through deduction affect other real estate businesses? So if you're not running a service business, and so we're going to focus on not running a service business here. If you're not running a service business, we've still got those thresholds to deal with. So that 157.5 if we're single, the 315 if we're not. If we're under those thresholds, we just get a 20% deduction on our business income. If we're over those thresholds, we will still qualify for a pass-through deduction. That's the difference with service businesses. If service businesses are over those thresholds and outside of the phase-out range, which I talked about earlier, then service businesses do not qualify for a pass-through deduction, but other businesses do. So if you're building, if you're developing, if you're flipping, you're going to always qualify for the pass-through deduction. Well, I shouldn't say always, because always gets you into trouble. In most cases, you will qualify for that pass-through deduction. So here we have an example. So let's say that let's say you're flipping properties and you net $400,000 in income. And as part of that, you also pay $100,000 in wages. Your pass-through deduction is going to be the lesser of 20% of your QBI, which was the $400K. So that's $80,000, or the greater of 50% of the wages paid, which is $50K, or 25% of the wages paid. And we didn't have property here, so just 25% of the wages paid. So basically, our deduction is the lesser of 80,000 or the greater of 50 or 25. So we've got 50. That's the greater of 50 or 25. So now our deduction is the lesser of $80,000 or $50,000. And in this case, it is $50,000. So as you can see, wages play a significant role now into how much of a deduction you get. So if you're running an S corporation where you are paying yourself, carefully consider how much you are paying yourself. Theoretically, we would want to drive wages down, right? If we drive wages down, we increase our net income from our business, or at least the net income that qualifies for QBI. So if we pay less wages, we increase our QBI, and as a result, we increase our 20% pass-through deduction. That's if you're under the taxable income threshold. If you're over the taxable income threshold, it might not work out like that, because you might now have to be subject to those wage limitations, which I just showed you an example on. So now you might actually want to pay yourself more in wages, you might want to contribute to a retirement account like a solo 401k in order to drive that total taxable income down. There's a lot of different things that we need to be analyzing here. So again, make sure that you connect with a CPA on this that understands this stuff and can apply it to your business. It's very important that you get this right this year and for the next 8 years. This is a freebie tax deduction if you can structure it appropriately to take it. Another strategy for you, going back to the whole paying your children thing. Well, in the past, we would pay our children up to $6,350, so $6,350 per year. The reason for that was because in the past, $6,350 was the standard deduction. Well, now the standard deduction is $12,000. So we could theoretically pay our child up to $12,000. We get a federal and a state tax write-off for that $12,000 payment to our child as wages, right? So we're paying them to work in the business. Get a federal and state tax write-off. The child gets the income, doesn't have to pay taxes on it at all. There's no FICA taxes for children. There's an exemption until they turn 18. They don't have to pay federal taxes on it because they don't have to file a tax return because they're under that standard deduction. So we have a really cool opportunity here. Now, the question is, can my 7-year-old earn $12,000? Probably not. We don't want to pay a child $200 an hour, and we certainly are not going to pay somebody $12,000 to, I don't know, clean up trash in one of our rental properties for a few hours a month. But you can work with your CPA on this and structure paying your children, and just understand now that if you can pay up to $12,000 per child without subjecting them to filing a tax return. And again, you get that federal and state tax write-off. When you pay your child, it drives your net income down. So now we're paying our children, we're driving our net income down below those taxable income thresholds. Again, 157.5, 315 if you're married. We get our income below that, boom, now we have a 20% pass-through deduction on our net business income. So really cool stuff here. Okay, we are going to take a quick breather. I'm going to take a sip of water. 1 second. All right, if you are interested in our services, you can navigate to the realestatecpa.com/clients. If you have any questions, take a second to kind of process everything I've been talking about. I know it's a lot of stuff. I know it's dense. We're trying to present it in the best format that we possibly can with some examples, but I'm sure that there's tons of questions. So you have a couple options with the questions. You can open up that Q&A button, ask a question there. It looks like Ben and Taylor have been answering quite a few questions. You can also look at the answered questions to see if your question's already been answered. You can email us at contact@therealestatecpa.com, or you can connect with Thomas or I on LinkedIn there. So if you have questions, please ask. We want to try to help you out. But again, don't give us too many factual details. We don't want to dive too deep into the weeds on your particular situation there. I want to keep it more high level, at least in this format. But if you email us with your particular situation, we might be able to help you out. All right, Section 179, expensing and 100% bonus depreciation. Section 179, when do we use it? Well, the Section 179 has been called the Hummer tax, right? So this is the section of the tax code that allows you to write off a vehicle and fully expense it if it's over a certain amount. I think it's 6,000 pounds. Section 179 here has doubled. So now the maximum that we can write off in any 1 year is now $1 million under Section 179. The other cool thing that's happened, this only applies for non-residential properties. So we've got commercial properties, office space, retail space, those types of properties, warehouses. Section 179 now allows you to fully write off the cost of a roof, HVAC, fire protection, alarm systems, and security systems. So anybody that owns like a triple net lease or like an office building somewhere, you guys have just been thrown a bone here, and you can now fully deduct the cost of these repairs in year one under Section 179. And it's nice because otherwise you would have to depreciate those generally over 39 years. So it really accelerates the how quickly we can write that off. That does not apply to residential properties. And remember, guys, residential properties are where people live. So that also includes very large apartment buildings. You could have a 1,000 unit apartment building. It is still considered a residential property and would not qualify for this Section 179 expensing. But we now have 100% bonus depreciation, which is awesome. So previously we had 50% bonus depreciation. They've doubled that. Now it's 100%. And it's 100% for qualified property with a recovery period of less than 20 years. That is the key. So no, you cannot go buy a rental property and fully depreciate it or write it off under 100% expensing in the first year, because rental property has a useful life of 27.5 years. But you could buy a rental property, do a big rehab on that rental property, get a scope of work, and potentially 100% bonus depreciate some of those items on that scope of work. Or if you're doing a rehab at some later point, you keep a really, again, solid records, really solid scope of work, itemized out. Now we can potentially 100% or take a 100% bonus depreciation there. So that is cool because we can write everything off in year one. We don't have to wait over a 5, 7, or 15-year period. And 5, 7, and 15 years, that's personal property and land improvements. That's the general useful life for those, at least in terms of the IRS's eyes. We no longer have to wait there. We can just write everything off in the current year. All right. Section 179, just the thing here, you can't reduce income below zero. Bonus depreciation, again, useful life of less than 20 years. Cost segregation studies. Anybody that's doing a cost segregation study will now highly benefit from 100% bonus depreciation. If I buy a property in 2018 and then I get a cost segregation study done on that property in 2018, this is assuming I don't do like a major rehab. I get a cost segregation study done on that property, well, I get to 100% bonus depreciate the personal property that the cost segregation study broke out. So if I go back to my 110K property example, where $100,000 was the unadjusted basis of my property, generally speaking, in a cost segregation study, you can pull out anywhere between 20 to 40% of that unadjusted basis and reclassify it as either personal property or land improvements. So I could theoretically pull out $40,000 of that 100K, that 100K adjusted basis. I could pull out $40,000 and classify it as personal property or land improvements through a cost segregation study. That's what a cost seg study does. And the benefit is that I now get to write off that 40K over a period of 5 years, 7 years, and 15 years. So I've accelerated my depreciation. And what it does is it results in a bigger write-off for the first 5 years of ownership. What we're now seeing is because we have 100% bonus depreciation, I could theoretically write off that entire $40,000 in the first year. So really cool bone that was thrown to the cost seg experts, and definitely something that you want to consider for any size property, really. Something on cost segregations that you should probably consider is if I get a cost seg study done in 2018, or sorry, if I buy a property in 2018, I need to get that cost seg study done before I file that 2018 tax return. To qualify for 100% bonus depreciation, the property has to be new to you. It doesn't have to be brand new property. It can be used property, but it has to be new to you. So what I can't do is buy a property in 2018, wait until 2020 to do a cost seg study. It's not going to result in 100% bonus depreciation. It's still going to help you out, but not nearly as much as it would in the first year. So there's also a little bit of pressure now to kind of reach out to these cost seg guys and get this stuff done. That said, make sure that whoever is doing your cost seg study is qualified. There are a lot of people out there that are doing cost seg that don't have the background for it. It's really kind of the wild, wild west. You don't have to have a certification for it. So just be very, very careful with who you engage there. All right. One thing that we need to mention here, one big caveat to the bonus depreciation is that it is bonus depreciation. It's an expense, but it's not what we would call like a hard expense. So paying your accountant $10,000 is a hard expense that you get to write off in the current year. 100% bonus depreciation, it's an expense, but we have to recapture it at some later point. So we want to keep that in mind as well. Strategies to avoid recapture, we could obviously do the classic 1031 exchange, or we could buy new assets and undergo cost segregation studies. So if I'm selling an asset in 2018 and it's got a $100,000 gain built in, maybe I go and buy another property that I can write off $100,000 in 2018 via a cost segregation study to offset that. And that would not necessarily be a 1031 exchange. It could be completely outside of the scope of a 1031 exchange. So something to think about. I know I'm saying that a lot. There's a lot to think about in this in this presentation and all these new tax laws. Does 100% expensing mean that I can deduct my entire rehab cost? No, it does not, because there are going to be structural components as part of your rehab costs. So you might be putting up drywall, you might be fixing the flooring, you might be fixing the foundation. That's all structural, has a useful life of greater than 20 years, will not be eligible for 100% bonus depreciation. But if you, again, keep that itemized list of what you're putting into that property when you place it into service, you can 100% expense the land improvements, 100% land improvements and personal property. And guys, I don't know if you know, but like if you do any sort of big land improvements, like taking down a tree or planting new trees or a driveway, those are all land improvements. So now all that can be written off in that first year. Business interest limitations might affect you. There's a lot of confusion around this because one of the exceptions, as you can see below, is that if you earn less than $25 million a year in gross revenue, you're excluded. So for most of us, I would assume most of us, unless you're just rolling in the dough, you earn less than $25 million a year. But, and we'll talk about this in a second, if you're a tax shelter, which a lot of you could actually be running tax shelters, it's not going to be that great. So business interest is now limited to 30% of the business's adjusted taxable income. Adjusted taxable income generally means EBITDA. EBITDA is your earnings before interest, taxes, depreciation, and amortization. So basically my operating income. I have $10,000 net income before I take interest, taxes, depreciation, amortization into account. If I have a $10,000 net operating income, then $3,000 is my interest limitation. So you can see that if I have a very debt-heavy property, then it's going to hurt because I'm only limited to that $3,000 interest deduction. This only lasts until 2022, where the calculation then reverts to EBIT. And I'm not sure why. Oh, there it is. Yeah, EBIT, earnings before interest and taxes. So now they're going to be factoring in depreciation and amortization. Take that same example, $10,000 net operating income before my interest, taxes, depreciation, and amortization. What happens when I factor in depreciation and amortization of, say, $8,000? That results in my EBIT, my earnings before interest and taxes. In this example, it's $2,000. Now my interest is limited to $600. That's my deduction. Now, if I can't take the interest, it does carry forward into the future. So I will be able to benefit from it at some point, but a really big bummer here if I can't take my interest. As I said, there's an exception if you earn less than $25 million a year, which is probably everybody on this call or the majority of us. You are excluded from this interest limitation rule unless you're running a tax shelter. So what is a tax shelter? In the past, a tax shelter has been really deemed as a tax evasion or a tax avoidance type of entity. It's basically there for no other purpose than to avoid taxation. Now in section, sorry, I just hit the mic, didn't mean to blow your ears out. Now in section 163J, and this is where all this resides, a tax shelter is any partnership or S corporation that allocates more than 35% of its losses for the year to limited partners or limited entrepreneurs. Who does this primarily include? Anybody who's given an equity stake to private money individuals, right? They are generally limited partners. They're not making management decisions. They're not actively involved in the business. If they own more than 35%, you could be subject to these interest limitations. If you are a syndicator, you are probably subject to these interest limitations because in syndications, the 30% will be the GP stake and then the 70% will be the limited partner stake. So you could be, I mean, we have some clients that are syndicates and they're grossing $200,000 a month and their interest write-offs are like $80,000 a month. Well, if they're giving the majority of their entity, of their profit stake and their loss stake to limited partners, now they're limited to the interest that they can actually write off. It's not a good thing. So how do we get around that? We want to actively participate in the partnership's activities. A little bit easier said than done. If you have a small partnership, you can probably do this. So again, how do we get that private money partner, that guy that's just sitting on the beach and collecting his checks? How do we get him actively involved? How do we raise his level of participation to active in the business? If we can do that, we will probably get around the interest limitations. Don't give up more than 35% to limited partners. Again, easier said than done. Very difficult to do, especially if you are syndicating and raising millions of dollars in capital. But this will probably allow for, at least if we understand that 35% is the threshold, we will start to try to figure out different ways to structure these syndications and different ways to structure real estate deals going forward. And of course, there's the one that's actually in the tax code that says that you can elect to be considered a real property trade or business. So the syndication who's like, oh my gosh, or if you're even just a regular old entity and you're like, holy crap, this is really going to crush me. There's no way that I can get around it at this point because it's not like I'm starting new. I've already got it all and everything, or there's just no option. I'm starting it new, but I have to give away more than 35% to limited partners. It's okay. You can elect to be considered a real property trade or business. The election gives you an exception to the interest limitations. So if you make that election, you will not have interest limitations on your net operating income. The caveat or the trade-off is that you will have to depreciate your property on the ADS system, and the ADS system has different class lives. So for residential, it's 30 years. So now we're depreciating our property over more than 30 years, over more than 27 and a half years. So now 30 years. And then for non-residential, it's 40 years. Not a huge difference because we're only going from 27 and a half years for residential to 30 years, and then 39 years for non-residential to 40 years. That's not the big deal. What's the big bummer is that I can no longer take 100% bonus depreciation. So the syndicate that makes the election to tax or to be considered a real property trade or business will not see massive benefits from those cost segregation studies, at least in terms of the 100% bonus depreciation. All right, corporate tax rates have changed. They've dropped to 21% from 35%. Now, should you switch from an LLC to a corporation or from an S corporation to a C corporation? No, there's really no benefit to, at least for most landlords and for most businesses. There's not going to be a huge reason to do so. The Congress was smart enough to understand that if they lowered the corporate tax rate, they also had to do something for the pass-through entities, and that's exactly what they did. The pass-through entities will generally still afford you a better tax position overall. 1031 exchanges were modified to put emphasis on real property. The big question right now that a lot of people in the CPA community have, and that I still have, is when I do a 1031 exchange, if I have previously performed any sort of cost segregation study on that property, or if I've been reporting personal property assets on that property, will they qualify for that 1031 exchange? The sentiment is that yes, they will. But right now we're awaiting further guidance because there's no hard and fast answer that says that, yeah, personal property inside your rental is still going to carry over in that 1031 and it's going to qualify. But because of the emphasis of real property, because 1031 exchanges pretty much cut out personal property, there is a chance that it could just be the basis, the unadjusted basis, the property that you can really push over and with a 1031. DPAD's been eliminated. That really affects flippers and developers, but with the elimination of DPAD, we now have this 20% pass-through deduction, so it's kind of a trade-off there. Rehab tax credit's been modified a little bit. We're not going to jump into that, but that is it, guys. We're running a little bit over, but we've got about 10 minutes here for some Q&A. Before we jump into that, feel free to join our newsletter. That is a live link if you're watching on the PDFs, so you can click that. You can jump into or subscribe to our newsletter there. And if you subscribe, we will be sending out a replay of this webinar tomorrow, along with the PDF presentation in case you've missed downloading it. But we're only going to send it out to newsletter subscribers. So we're not going to put this anywhere else. Then check out our podcast, The Real Estate CPA. It's on iTunes. That's also a live link. And then again, connect with me and Thomas on LinkedIn. We would love to hear from you. We would love to be connected. I like to write a lot about like how much the corporate world stinks and all of that. So if you're into like, I don't know, the corporate world bashing, by all means, follow me. I welcome it. And not to say that I hate the corporate world. I don't. I just, experience wasn't that thrilling. All right, guys, we're going to do some Q&A now. I've got some questions here that have been identified for me to answer live, and feel free to pile on the questions here. If we don't get to you, please send us an email at contact@therealestatecpa.com. Ben or Thomas, if one of you guys could throw that email into the Zoom chat for everybody, that would be good because we're probably not going to get to everybody here within the next 10 minutes. First one, if you get a HELOC on your investment property to buy another investment property, can you deduct the interest? Yes, you can. So that's still allowed. Regarding W-2 wage limitation for the 20% deduction, is a guaranteed payment via K-1 considered a wage, or must it be a W-2? Very good question. We think it's got to be a W-2, but again, we are awaiting further guidance. What bonus depreciation is available for residential real estate? How about commercial real estate? Bonus depreciation, again, guys, it's 100% on assets that have useful life of less than 20 years. I think that question might have come in before I explained all that, so hopefully that covered all that. All right. Please clarify, I am a landlord and I manage my own properties, but my LLCs are single member. I don't get the 20% deduction. You do get the 20% deduction as long as your taxable income is below the 157.5K threshold if you're single, or 315K if you're married filing joint. If you manage your own properties, you're still going to get that qualified business deduction. If you outsource the management, you have a property manager, you're still going to qualify. Where you probably won't qualify is if you own a triple net lease property where like Verizon does everything for you. That's the instance where it's probably too passive to really demonstrate that you've actively participated, and you might not qualify at that point. Again, though, we are still awaiting further guidance to really figure out who's qualifying and who's not. All right. Trying to figure out what the next one I want to read. In order to get the bonus depreciation in residential property, must we always get a cost seg study, or can we itemize ourselves? Yes, you can itemize yourself. So, well, okay, let me back up. You can itemize yourself if you're able to find, like let's say I buy a property and I've got some appliances, and I want to figure out what the cost of those appliances are, and I want to allocate some of that purchase price to the appliances. I can do that myself. I can go onto eBay, I can go onto Amazon, I can find a similar model, similar make and model, and price it out that way. But you're not going to reap the benefits of a cost segregation study. So you'll get something, but you're not going to get like the professional, here's exactly what your valuation is for all these assets. And the reason for that is a professional is going to look at a blueprint of your property, and they're going to map out some of the electrical components, some of the plumbing components. Basically, if the electricity or the plumbing feeds your appliances, then the electricity and the plumbing is also personal property. And that's what a professional is going to do. They're going to be able to come in and identify that. So you do get a bigger benefit if you get a legitimate cost segregation study performed, but you can do some of this stuff on your own. You don't need to hire somebody. It's just going to be a little bit smaller. And yeah, it would qualify for that 100% bonus depreciation if you did that. Okay, does 100% bonus depreciation rule apply to 2017 tax returns, or does it apply to 2018 moving forward? Great question. So the 100% bonus depreciation is retroactive starting September 27th, 2017. So if you did any sort of rehab in Q4 of last year, you're golden. You're good to go. Let's see. We're going through these. Man, you guys are asking a lot of great questions. I'm not going to be able to get to everybody, but please do reach out to us via that email afterwards, because we definitely want to help you guys. Are there tax implications to transferring rental properties into an LLC after purchasing the property as an individual or sole proprietor? Not on a federal level, generally not on a state level. So the question is, if I own property in my own name, and then I set up like Brandon Hall Capital LLC, can I move the property into the LLC? Yes, you can. What you need to watch out for are transfer taxes. So get with a local attorney and understand what those transfer taxes might look like for you. Some states, there are no transfer taxes. You can do it pain-free and you're fine. But like Pennsylvania, for instance, I think they charge, somebody's going to correct me, it's like either a 3 or 3.3% transfer tax. So, you know, if your property's $100,000, you're paying $3,300 to get that thing into an LLC. So it's something to watch out for that could come up to bite you. Can a driveway installed this year on a rental home can a driveway installed this year on a rental home purchased multiple years ago still be expensed with the bonus depreciation? Yes, it can. So even if I bought a property back in 1900, which I didn't because I wasn't alive, but if I did, I could still do some rehab this year or next year or the year after that and qualify that rehab for the 100% bonus depreciation. Again, what you have to look out for is the useful life of the asset that you are placing into service. So the driveway here would be an asset that we're placing into service. As long as the useful life is less than 20 years, then we're good to go. And by the way, guys, useful life is not what you think useful life is. It's not what the company that's installing this thinks that the useful life is. It's what the IRS thinks the useful life is. So the IRS says personal property has a useful life of 5 years. Land improvements have a useful life of 15 years. So even though the driveway could probably last 30 years, the useful life is only 15 years. HVAC units have a useful life of 15 to 20 years. In reality, they do. But the IRS says it's a 27.5 year property. Okay, so keep that in the back of your mind as well. Is there a way to copy the entire Q&A chat? I love that question because we've been trying to figure that out myself. I don't know. I'm sorry. I know that this is a lot of good stuff. Maybe there is. Maybe Ben or Taylor could try to figure that out here in the next couple of minutes. I'm really not sure. The income limitation of 157,315 for each LLC entity or your total income of all sources. Yeah. So the income limitations, again, 157.5K if you're single, 315 if you're married filing joint. These income limitations are what shows up on your 1040, and it's your taxable income. So it is going to take into account all of the income that you earn from every single source. And it just boils it down to that 1040. So what shows up as taxable income on your 1040? That's what the question is. That's what the important question is here. So it does take into account everything, all income sources. The 315K married is the threshold for all entities owned if you have multiple LLCs. I think that I might have just answered that same question with this. So again, taxable income, guys, on your 1040, what appears on your 1040 as taxable income, that's the threshold. That's what affects the threshold, taxable income. Oh, okay. How does a 1031 work if you have done a cost segregation study and segregated personal property? My understanding is that only real property qualifies for 1031 exchanges. And that's what I was talking about on one of those last slides. We're not sure yet. The sentiment, at least in the CPA community, as far as I know, is that 1031s will still encompass everything inside that rental property. So even if you did a cost segregation study and you've identified all this personal property, it's still all going to qualify. But we have to await further guidance because the way that the code is currently written is that, at least the way that the law was written and passed is that if you do a cost seg study, you now have personal property and the personal property does not qualify for 1031 exchange. So again, one of those things where we have to wait on further guidance. And when I say we wait on further guidance, who knows how long it's going to take. We're kind of expecting over the next 60, 90 days. The Treasury is supposed to release 80 memorandums over the next few months here. So I don't know how long it's going to take, but hopefully it's shorter rather than longer. Would it be a good idea to put rental property in an S corporation? All right, there's still 114 of you here, so you are lucky. Okay, listen to this. Never, ever, 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 ever. 113. Somebody just left before I got to say it. That is disappointing. Never, ever, ever, ever put rental property in a corporation. It's a great question, and it should be asked, but don't put rental property into an S corporation or C corporation. It causes a lot of basis problems. It becomes inflexible. And then if later, like later, let's say that you want to move the property out and back into your personal name, it's a taxable event. So don't do it. Just keep it into an LLC. It's fine. You're still going to get the same benefits in terms of the pass-through deduction as you would if you put it into an S corporation. Okay, I think that's it. I tried to answer as much as I could. It's 8 o'clock. I don't want to keep you guys. Thank you so much for attending. Again, if you have more questions, email us at contact@therealestatecpa.com. One of our tax strategists will try our best to answer your question. We're not going to necessarily jump into grave detail. We do want to have a signed engagement letter to really be delivering hard-hitting advice, but we will try to help you out as much as we possibly can. So email us at contact@realestatecpa.com. Sign up for our newsletter. Check that out. I think the link is in the Zoom chat, so sign up there. And thanks a ton, guys. I really appreciate you guys having us on and giving us a chance here. Have a good rest of your evening. And for the Northeastern folks, stay warm. It's going to be a cold weekend. Bye now.